Welcome to All About Stocks, a show specifically meant for retail investors. On this show, we'll tell you what you should be doing, especially in a market like this one, which I realize must be scary and confusing for you. Now, as a special treat for you this weekend, Nilesh Shah is in the studio with me to help us through this time. Nilesh, thank you so much for joining us, especially in a market like this. So I'm really happy that you're here because I know that a lot of retail investors right now are going to be extremely concerned with what's happening. It's one of those times in the market where my equity portfolio is not doing well. It's causing me nervousness. My debt funds are down. Gold is down and real estate is not performing. So if I step back and look at the entire portfolio, it's not a pretty picture at all. So if I were to walk into your office and say exactly this as an investor, what advice would you give me?
So my advice to investors will be that, look, Sachin Tendulkar didn't become a great cricketer by hitting every ball for 4s and 6. He probably has spent, much more time on the pitch facing those 30,000 odd balls to score 15,000 odd plus runs. So there will be overs where you just have to, play it out. You don't hit 4s and 6, but if you're standing on the pitch, you'll be able to eventually get a ball which you can hit for a 4 and 6. So this is the phase where you just have to wait it out in the market.
See, I'll give you an example of the kind of, questions we're getting. And this one came in on Twitter for you. Raj wrote in. He said, please ask Nilesh Shah whether he foresees a major market fall in the near future, meaning in the next 6 to 12 months. Do you think it's going to get a lot worse? Which is fundamentally what he's asking.
So today markets are trading at fair value. And for markets to give a major correction from here, market has to become really cheap. Now, when did the market become cheap? In the early 90s, market became cheap after a scam broke out. In 2000, markets became cheap when technology, media and telecom bubble busted. In 2008, market became very cheap when, Lehman Brothers crisis happened. And in 9/11, again, market became cheap when a major terrorist attack shut down the financial markets in US. So unless until this kind of exigencies happen, I don't see a reason how markets will become cheap. Today, we are worried about three things primarily. One, corporate earnings haven't grown as much as they should have grown as per the expectation. Second, the monsoon is likely to be weaker. And third, the US Fed is likely to raise interest rates. Now, these are the three reasons which people have already known. They have already been priced in, albeit partially into the current levels. Now, anything happening on this line is not going to impact markets substantially to make it very cheap. Unless until we see a action or an event which is not priced in today, which is not known to the market today, that's not going to bring a market correction.
So if I'm going to play out these overs, does this mean that I continue to invest, I look for value, or I just hold what I have right now and say, okay, I'm just going to wait and see until I see some sort of trigger come in?
No, you have to take advantage of correction in the market. If market was, giving value, let's say at 30,000 Sensex, at 27,000 it is giving better value. And you have to grab the opportunity to buy it when the market is in correction mode. Yes, it is likely that market will consolidate around current levels because the earnings haven't grown as fast as one would have expected. RBI's revision downwards of GDP growth and revision upwards of inflation has also kind of hit the market. But market is ignoring that RBI did cut interest rate by 25 basis points and banks are following up on it by cutting their base rate, which will be beneficial to the corporate earnings growth. Market is worried about monsoon, but they are failing to appreciate at 88% of average, it is still as good as last year. And last year market did went up despite 88% monsoon. The market is worried about US Fed rate hike, but market is again forgetting that yes, our markets did correct in mid-2013 when the word was going around that quantitative easing will be stopped. But when the quantitative easing actually stopped, market went up significantly. So don't worry about the near-term consolidation phase in the market. Grab this opportunity to buy whenever there is a correction in the market and then wait on the pitch to see the right ball. You'll surely get a 4 or 6 over there.
But then it also depends on whether I'm playing T20 or I'm playing a test match. How long is this period going to last according to you?
The market is always test match.
Always
it can't
test
be
match.
T20.
Okay.
You just get lucky when you get an over like T20, but you're playing for the long term. So play for a test match, play with discipline, play with participation for a longer term rather than short term.
More Rahul Dravid, less Virat Kohli, basically.
Definitely.
All right, so if we actually look at, and you listed out all of the news that we've heard, there was the RBI's announcement about inflation, the fact that we might not see rate cuts till the end of the year perhaps now. Greece is starting to cause some concern globally as well. Monsoons, earnings, inflation. We can't have Maggie anymore. There's a lot of bad news. Of all of these things, what's causing you the most concern when you look at the last 1 month? What do you think is the the most worrying of the lot?
I think everything else is noise and we can live with it. The real cause of concern is that in the second half of 2015, earnings growths have decelerated. For the quarter ending December 2014, large cap companies delivered negative year-on-year earnings growth. And in the quarter ending March 2015, even the blue chip companies across technology sector, pharma sector, PSU banking sector delivered substantially below expectation results. This slowdown in earnings is the real cause of correction in the market.
We were at about 16.5 valuations before the market began to correct, and there was all of this talk about it's all overvalued and things like that. And now it's come down, and now there's a completely different message going out from analysts. Would you say the retail investor at this point should just ignore everything, especially the technical analysis that we're hearing, all of that noise, and just say, okay, this is my target, I'm just going to continue to invest perhaps in an SIP?
So, there is a lot of information for traders which becomes noise for investors. Equity is a lifestyle choice. Equity allows you an opportunity to partner with the best entrepreneurs of the country and make them work for you. You have a choice whether you want to work or you want to make best entrepreneurs of India and the world work for you. So you have to look at equity investment from that point of view, and that's where all this information becomes a noise for you. When markets correct from a valuation point of view, that's a great opportunity to make long-term wealth. So clearly this consolidation phase allows you to enter into market at a much lower valuation than what you were getting into earlier, and that's a great opportunity. Now it won't give any instant gratification, but market always rewards patience. It never gives instant gratification unless until you are extremely lucky.
This is interesting. Apart from all of the noise that we're hearing, if we step back and just on the Nifty look at the larger picture, the 2-year return on the Nifty is still 37%. The 3-year return on the Nifty is closer to 68%. So if I now have a 2-year, 3-year, maybe a 10-year horizon on the market, can I continue to expect this sort of performance? What could I expect?
So definitely returns will moderate. Because in last 2 years, Nifty has been re-rated from 12-13 times to about 16 times forward earning. I don't think so we can expect further re-rating of Nifty from current level. Now whatever returns we are going to get is linked to our profitability growth, and it will be difficult to see a very high level of profitability growth sustaining which can justify the returns of last 2 or 3 years. So returns will moderate, but what we have to look at is a relative return rather than absolute return. Relative to debt, will we get better return in equity? The answer is yes. Relative to gold, in rupee terms as well as in dollar terms, will I get a better return in Indian equity? The answer is yes. Relative to real estate across most parts of India, which has become expensive and which has started witnessing correction, will I be able to get better return in Indian equity? My answer is yes. So you are not going to get similar return to what you got in equity in last 2 years, but your overall return in equity will be superior compared to debt, real estate and gold for sure.
It's time for us to take a very, very quick break, but when we come back from this break, we'll talk about specific sectors and specific strategies. Welcome back. You're watching All About Stocks on ET now. Thank you for staying with us. Nilesh Shah is in the studio with me. Nilesh, I have another question for you that came in from Abhishek Pandey on Twitter. He's 28 years old. He said he's just started to build his portfolio. And I know you don't talk about specific stocks. You don't have to comment on them. He right now only has BHEL and Suzlon in his portfolio, and he doesn't know what else to add and what valuations he should look at. He said, now looking at the valuations, what should I add? This could be a case of a young investor possibly overthinking the whole thing. What advice would you give a 28-year-old who's looking to build a portfolio in this market?
So first advice will be that it's never too late to start. So whatever you are earning, do try to save, because when you start early, it gives a tremendous advantage through compounding. Second, you should never own just 2 stocks in your portfolio. You have to be diversified. So at least build a portfolio of 15-20 stocks after doing proper research. And if you don't have time to do the research, then please do SIP in mutual fund. Third thing, you try to figure out what you are doing in terms of your consumption. Is your bank account opened in a PSU bank? Is it opened in a private bank? If it's in private bank, then try to own private sector banks. What are you eating in terms of food? What are you spending in terms of entertainment? I mean, these are the options where hopefully the other young crowd also will be following same pattern which Abhishek is following. So invest in what you are consuming as a consumer, because you are going to make future of those companies. So be diversified, start early, focus on research rather than tips, and be diversified.
You also said in one of the interviews you just gave a couple of days ago on this channel, you said roads, railways, power, mining, this is where a lot of the action is happening right now. This is where the government is focusing their energy. But if I then stay within the consumption stocks that actually touch my life, that I'm familiar with, I know these companies, all of this will sort of get left out. And for example, this is how investors invest in pharma stocks that they don't really understand the business of. There's a fear that maybe there are sectors that I don't understand, that don't affect my life, but there's a lot of growth in. What's your answer to that question?
So, if you don't understand the sector, it's better to invest via mutual fund, where there are qualified people who are doing this job 24/7. Clearly, it's important to be diversified. No one has seen the future. No one can predict the future. All of us are making legitimate guess based on the information available today. And there are good chances that we will go in some of the cases. But as long as our wins are more than our failures, will still produce return for our unit holders. So either you do your research, and if you are not able to do, then let the experts do the job. The reason why I recommended consumption is because people do spend money. They spend money on entertainment, they spend money on healthcare, they spend money on food. Now, then you know where the pattern is changing. I mean, if the trend was to move from scooter to motorbike, that was reflected in stock market return as well. If the trend was to move from cinema to multiplex, that was reflected in stock market as well. If the trend was to move from no exercise to reasonably focused exercise, that was reflected in stock market. So where the young generation is spending money, that's where the future growth will be, and they can capture that through their own consumption pattern.
Just to clarify, if we have a subdued economy for at least another 6 to 8 months and a subdued festive season as a result, then consumption will be subdued. But what you're telling us right now is a long-term view, right?
It's a long-term trend. I mean, you're not playing it for next 3-6 months. You're playing through an SIP over next 5, 10, 15 years.
It's interesting. This is the same advice you gave Jim Rogers when you said, I urge you to consider investing in equity funds because most of us are outperforming the benchmark by large margins. You expecting that sort of outperformance to continue?
So eventually these margins will start narrowing down. I mean, clearly the margin with which we have outperformed benchmark indices over the last 15, 20 years, that's not going to get repeated over next 15, 20 years unless until we are very, very lucky. But will we still be able to justify our job by giving reasonable outperformance over benchmark indices? The answer is yes. I mean, just one point which today's investors have to figure out is that till now, none of our provident funds has ever invested into equity market. Now the government has given them the mandate or the approval to invest between 5 to 15% of their flows in equity market. The present corpus of EPFO and non-EPFO provident fund is almost 13 lakh crore. 15% of that could be 2 lakh crore. None of that will get invested today. But over next 5 years, could we assume that if equities deliver good return, 15% that money could actually come into equity market? Now that means over next 5 years, we'll see incremental flows of 40,000 from set of investors who have never invested in equity. Now you have a choice. Do you want to stay ahead of those flows? Do you want to follow them? Or do you want to be with them? Following them probably will not be advisable because by then that buying would have impacted the price. So you have a choice either to stay ahead of them or with them.
What's your call on the real estate market going forward? And as an investor, why should I hold back from making that real estate investment and consider equity instead?
So today, if I see retail investors' balance sheet, excluding Indian promoters, they have about $10 to $12 trillion of real estate. Substantial portion of Indians' wealth is in real estate. Their investment in fixed deposits and other fixed income instrument is roughly between $2 to $2.5 trillion. Their investments in gold is anywhere between $1 to $2 trillion. Who knows what the real number is? But their investments in equity is just $300 billion. So clearly from an asset allocation point of view, you are too overexposed to real estate and too underexposed to equity. The ownership of BSE 200 in the hands of retail investors based on March 15 number is just 8%. You have given away the right to sit in the fast moving train and put yourself or parked yourself in a slow moving train or even a reverse moving train. That way you'll never be able to reach your station of financial liberation. So one, from an asset allocation point of view, as more and more people realize that either I'm sitting in a reverse moving train and I need to jump into fast moving train, they'll move from real estate into equities. The second thing is this whole supply which is overhanging on real estate. Across majority of the cities, we have now supply of unsold flat which are constructed by builders but not sold to the consumer,
36
ranging
months
between
worth
36 months to 48 months. Now when you have so much of supply, eventually prices will correct. Either it will give time correction or it will give price correction. And I still remember in the late 90s, real estate did give a correction of about 30% in Mumbai. So today, either because of supply overhang or because of the affordability or because of the overexposure, either ways it doesn't make sense for investors to own real estate but to move a part of it into equities.
We also have to talk about debt as an asset class, and there are debt funds that you look after as well. There are a lot of investors I know who are taking a sort of a strategic view on debt, saying that interest rates will continue to come down for the rest of the year, which is why I'll get into a debt fund and I will profit from it. What's your view now, since we are not going to see, when do you see the next rate cut coming, and what's your view then on debt funds?
So clearly RBI is, as per their policy, data driven. They'll wait for monsoon's impact and they'll wait for US Fed rate before rate cut can be considered. So that looks more likely in the last quarter of current year or first quarter of next year, assuming that monsoon is better than what is priced in at 88% of average and Fed rate hike is not as steep as has been priced in by the market. But most importantly, look at the RBI's commitment. They are talking about inflation targeting. The target is 6% CPI inflation by Jan 16 and 4% over medium term. Now, if and when RBI is able to achieve 4% inflation target and you add 1.5% for real interest rate, your target repo rate is 5.5% from current 7.25%. So, of course, RBI has taken a pause for the time being, but that pause is taken in order to ensure that we have lower interest rates over a longer period of time. And I'm sure RBI will be a winner in this battle against inflation, and they will be able to lower interest rates towards probably their target of inflation plus 1.5%. And that does open up room for rate cuts, albeit back-ended in nature, probably towards last quarter of this year or first quarter of next year. So as a fixed income investor, yes, last few days have been bad. Rates have gone up, NAVs have come down, but don't lose the patience. If you want to put more money, this is the time to put into the duration fund. One analysis suggested that whenever 10-year yield is above 8%, then 90% of the time you make almost double-digit return, lower double-digit return over next 1 year. My feeling is that this time also we are going to see the same thing.
All right, so if I right now invest in a debt fund for the next 1 year, I can look at least 11% return.
slightly less than that.
Slightly less than that, all right. Also, I mean, the fact that in a debt fund after 3 years it becomes largely tax-free, so if I have a slightly longer view, it'll be better than that. All right, so I'm also going to ask you this question before I let you go, and I do this to you every time I know. If I come to you with 100 rupees right now, and I'm just starting off, my portfolio is empty, I don't have anything. Of that 100 rupees, if you were to split it up across asset classes or across sectors or across mutual funds, as you were to please, how would you break that up?
So assuming that you are 20 years of age,
Thank you.
I'll put 80% into risk assets,
okay,
which is essentially equity, direct equity if you can do the research, or equity mutual funds to systematic transfer plan, so that this 80% gets invested over next 6 months rather than one go. And then I will ensure that there is an SIP from my future income to get invested into the equity market. And balance 20% I will put it into debt fund, especially in duration product, because right now rates are really attractive from an investment point of view. So about 20% in risk-free conservative assets and about 80% in risk assets. But then, it changes according to individual.
So that 80%, and I'll ask you the follow-up question that I know a lot of investors are thinking right now. Should I be putting that in equity diversified, in specific sectors? If I'm doing direct equity, then is it BFSI, is it large cap IT, is it pharma, is it consumer stocks? How would you split that up?
So maybe it's driven by the job I do, but if you have to depend upon television channel to figure out which stock and which sector to buy, then you're not really worthy to invest into the market.
Okay.
You create a blend of mutual fund portfolio, which is large cap funds, which is blend of large and mid cap funds, which is pure mid cap fund also if your risk permits. And if you really want to go for sector funds, please do little homework before you invest into sector funds.
I've always wanted to ask the mutual fund industry this. If I can do the job with diversified equity funds, maybe adding one mid-cap or one small-cap, 5 funds altogether, why does the industry have so many sectoral funds and thematic funds?
So, if you go to a restaurant, they serve you Mughlai food, they serve you Chinese food, they serve you South Indian food. I mean, within dosa, there are 20 varieties. Has anyone questioned that hotel? Why are you giving only 20 varieties of dosa and not one variety of dosa? So I am running a buffet because there is different appetite for different investors. And in my buffet, I have to satisfy all my customers. But you don't go and, hog on the restaurant saying that give me all the 20 dosas. You pick up what is suitable to you. So in my fund also, you have to pick up what is suitable to you. And many a times my fund's choice might become complicated to you. Then you go and take help of an advisor who will tell you that this is more suitable to you. But at Kotak Mutual Fund, we have done one interesting thing. We believe our funds are like our kids. We don't have more funds than what we can afford to. So we have very limited, just 6 equity funds.
That's always good news. So that's the interesting idea. Order only what's good for you and ask the waiter if you can't make up your mind. Nilesh, thank you so much for spending time with us this week. I'm sure you found that very useful. If you have a question for him, you can reach me on Twitter or you can email us and we'll ask him to be kind enough to come back into the studio and answer your questions. Thank you so much for watching. Happy investing.